Good morning. The mortgage trick that wealthy borrowers use that most buyers never learn. Hopefully, I can share something today. And most people assume that wealthy buyers purchase real estate with all cash. And it sounds logical. If someone has millions of dollars, why borrow money? But in reality, many wealthy borrowers intentionally keep mortgages on their real estate, even when they could easily pay cash. So, why? Well, that's a good question. And sophisticated borrowers can understand something that many buyers never learn. And real estate wealth is really built through leverage, but also maintaining liquidity and long term strategy, and not just interest rates. So, understanding this concept can completely change the way you think about mortgage financing. So, next topic is the biggest misconception about wealthy real estate buyers. Many buyers believe that their goal should be to eliminate debt as quickly as possible. Think Dave Ramsey style. But experienced investors often approach real estate very differently. So instead of focusing on paying off properties quickly, they're going to focus on maintaining liquidity, preserving capital flexibility, maximizing return on their equity, and using leverage to control larger assets, because appreciation is scaled at that point. And this strategy allows them to grow their net worth far faster than someone who's simply paying cash for a property outright. So, why wealthy borrowers often keep mortgages? And one of the biggest strategic advantages of a mortgage is capital efficiency. So, let's consider two scenarios. Scenario one, you pay cash. So, buyers purchasing a $2 million property in cash, and their equity invested is $2 million. And they've used up all of the liquidity, so they've got zero left over. But there is property appreciation, and it's limited to just that single asset. While this eliminates interest payments, it also concentrates all your capital into one investment, so all your eggs in one basket. So scenario two is using strategic leverage. So say a buyer purchases the same property for $2 million, but only with 20% down. So they have a $400,000 cash investment and a mortgage of 1.6. The remaining capital is 1.6 that's available for other investments. So now the investor controls the same asset while maintaining significant liquidity. And that capital can now be used for, say, additional real estate investments that produce income, but potentially for business opportunities or market investments, and having strategic reserves for breathing room. And this approach allows wealthy borrowers to scale their portfolio much faster. So let's talk about why interest rate is not the most important variable. And most buyers obsess over one specific number, and that's the mortgage rate. While the interest rate matters, sophisticated borrowers understand that the loan structure matters more so. And professionals tend to focus on the cash flow generated from the property, but also their liquidity preservation and the structure for the debt, and the inherent returns on their investment relative to their borrowing costs. So if a borrower can earn higher returns elsewhere, maintaining a mortgage can actually improve overall wealth outcomes, and you have a diversified portfolio at that point. And that's the real power of real estate leverage. Leverage allows investors to control a larger asset base with less capital invested. So for example, controlling a $2 million property with $400,000 investment, what that means for you is that a 10% appreciation on that asset creates $200,000 in equity growth. And that represents a 50% return on the original $400,000 investment. And that multiplier effect is why real estate has historically been one of the most powerful wealth building tools available to the average folk. So why liquidity is so valuable? Another reason wealthy borrowers keep mortgages is for financial flexibility. So if you have all of your cash tied up in one property, that's a liquid. And once it's invested, it cannot easily be redeployed without refinancing or selling. So by using mortgage financing, borrowers preserve access to capital for, say, new opportunities or economic downturn protection, having extra cash, or for portfolio diversification and strategic acquisitions of new assets. And liquidity often becomes the difference between investors who can act quickly and those who cannot. So let's talk about the role of a strategic mortgage advisor. And this is where working with a knowledgeable mortgage broker becomes critical. And a loan should not simply be viewed as a transaction. It should be viewed as a financial strategy tool. And professional borrowers often evaluate fixed versus adjustable structures, interest-only options, long-term versus short-term leverage, and portfolio strategy. And the goal is not simply getting the lowest rate. The goal is building long-term financial flexibility and wealth. So here's some final thoughts for the day. And most buyers focus on minimizing their overall debt, but experienced investors focus on maximizing opportunities. And that's why many wealthy borrowers intentionally use mortgages even when they could pay all in cash. Because when structured properly, leverage will allow you to control larger assets and maintain liquidity and scale your wealth over time. And if you want to structure a loan the way professional investors do, reach out to me. What I do is I help borrowers design financing strategies and not just get loans approved. My name is Bill Rapp. I'm a mortgage broker with Medallion Funds, and you can visit billrapponline.com to figure out more about my contact info and how to request a meeting. Love to talk to you more. Take care.